Chapter 12 talks about managerial accounting and the cost-volume-profit relationships. After studying this chapter, you should understand and be able to explain management planning and control cycle, identify the major differences between financial accounting and managerial accounting, describe the difference between variable and fixed cost behaviors in simplifying assumptions made in this classification method, demonstrate why expressing fixed costs on a per unit of activity basis is misleading and may result in faulty decisions, explain what types of costs are likely to have a variable cost behavior, what types of costs are likely to have a fixed cost behavior, use the high-low method to determine the cost formula for a cost that has a mixed behavior, explain and illustrate the difference between the traditional income statement format and the contribution margin income statement format. Use the contribution margin format to analyze the impact of cost and sales volume changes on operating income. Calculate the contribution margin ratio and explain how it can be used in CVP analysis. Analyze how changes in sales mix can affect projections using a CVP analysis, and describe the meaning and significance of the break-even point and illustrate how the break-even point is calculated, and use operating leverage to evaluate cost structures. Planning is a key part of the management process, and although there are many descriptions of that process, a generally accepted definition would include reference to the process of planning, organizing, and controlling an entity's activities so that the organization can achieve its desired outcomes. A general model of that process looks like the diagram that is here on the screen. This model suggests that control is achieved through feedback. Actual results are compared to planned results. If a difference exists between the two, then either the plan or the actions, or perhaps both, are then changed. Management decision-making occurs in each phase of the planning and control cycle, using information provided by the accounting information system in an effort to continuously improve organizational performance. These are just a few of the ways that management uses the information the accounting information system collects to enact decisions to further grow the company and make changes as necessary. Managerial accounting is the support of internal planning or future-oriented decisions that are made by management, where financial accounting is more of a scorekeeping and a historical orientation that provides information to owners and others outside the organization. It's the difference in the perspective of the reporting. So financial accounting's goal is to provide a report of what management has accomplished over a set specific period of time. Whereas managerial accounting is a little bit more in the moment, looking forward. And although both use the information in the accounting information system, they use them differently. Managerial accounting service perspective is internal to managers. Its time frame is the present and the future. Its breadth of concern is micro for individual units of the organization. Managerial accounting is reported frequently and timely, often within 1 day after an accounting period ends. The relevance is more important than the reliability, and no reporting standards are imposed on the reports that are created underneath managerial accounting. Where underneath financial accounting, its perspective is external to the investors and creditors. Its time frame is historical, and its breadth of concern is very macro over the entire organization. Financial accounting is reported monthly That's typically going to occur a week or more after the accounting period ends. And reliability is very important, and high accuracy is absolutely desired. The reporting standards are established by GAAP, and financial statements must be prepared using prescribed formats. Again, the same accounting information system is used for both financial accounting and managerial accounting. It is how we use that information and what we do with it that changes whether it's going to be financial or managerial. To start with, we're going to talk about the relationship of total costs to a volume of activity. Costs react to changes in the level of our business activities. These terms, variable costs and fixed costs, should be a little bit of a review from a prior course. Your total variable costs change when your activity changes, where the total fixed costs remain unchanged when activity changes. Cost behavior patterns react depending upon what type of cost they are. The fixed or variable label refers to the behavior of the total cost relative to a change in activity. When referring to the behavior of unit costs, however, the labels can be really confusing because variable costs are constant if we express them on a single unit basis, but fixed costs per unit will change as the level of activity changes. So it's really necessary to get down and understand how the behavior patterns of a total cost basis and a per unit basis react for variable and fixed costs. Variable costs will change in total as activity changes, but they are constant on a per unit basis within a relevant range. Fixed costs do not change in total activity as activity changes, but they do vary if we express them on a per unit basis as activity changes. So let's look at this next illustration that is going to dig a little bit deeper into costs. Some costs are partly fixed and partly variable. These costs have what's called a mixed behavior pattern, sometimes referred to as semi-variable. There are analytical techniques that can break the types of these costs into their fixed and variable components. As you can see, we've broken down total costs into its fixed and variable elements. Assume that it has been determined that the fixed cost for utilities is $350 per month, and the variable rate for the utilities is 30 cents per machine hour. We can calculate the total estimated utility costs for a month in which 6,000 machine hours are planned. Under these circumstances, we would expect total costs to be $2,150. Quite often, our utilities have a mixed cost component. There is some minimum that must be paid. That's like a tap fee, a service fee, just what you have to pay in order to have that service. And then there's that variable element. And that variable element that will change based off usage is, kilowatt hours, gallons, whatever the various metrics are for that specific utility, what is measured. Great care must be taken with the use of fixed cost per unit data because any change in the volume of activity will change the per unit cost. As a general rule, do not utilize fixed expenses because they do not behave on a per unit basis. Sometimes fixed costs must be unitized, as in the development of a predetermined overhead application rate. But it is important to recognize that the relevant range is often quite wide, and the significant increases in activity can be achieved without increasing our fixed costs. So, for example, most costs of a university business office, salaries, depreciation, and utilities are fixed. Let's say we wanted to calculate the cost of cashing student checks. We divide a portion of the business office costs, $1,200, by the number of checks cashed in a period of time. The results will be misleading. If 2,000 checks were cashed in a month, the cost per check is 60 cents. But if 6,000 checks are cashed in a month, the cost would be 20 cents. This is because most of those costs are fixed. They don't change based on the behavior of the activity. Recall the two simplifying assumptions that are made in connection with a determination of a cost behavior. First, the behavior pattern is true only within a relevant range of activity. If activity moves out of that relevant range, costs will change. Second, the cost behavior pattern identified is assumed to be linear within that relevant range, not curvilinear. So let's look at how that actually works. Acquiring office space as a business expands is an example of a fixed cost and the relevant range. Office space is available at a rental rate of $40,000 per year in increments of 3,000 square feet. As the business grows, more space is rented, increasing the total costs. So here we're examining the fixed costs and the relevant ranges that indicate that the total cost doesn't change for a wide range of activity, but then it jumps to a new higher cost for the next higher range of activity. So as you can see here, as long as we are at a specific range, we don't need that additional square footage. When we need it, we get a bigger jump, but we have quite a bit of time before we experience that again. So within this range, this cost is fixed. It is not changing. Typical fixed costs include real estate, taxes, insurance, supervisory salaries, depreciation, advertising. These are things that in the short run we really cannot change. They're set at a certain amount for a specific range of activity. Where variable costs are the elements like raw materials, direct labor, factory utilities, sales commissions, and shipping costs. When we're dealing with a semi-variable or a mixed cost, the high-low method is the one that we typically use to determine what the fixed component is and what the variable component is of this semi-variable cost. So we're going to illustrate the high-low method here in this slide. During the months of January through June, the following utility costs and total production volumes were determined by management. Management believes that utility costs are semi-variable in nature and asks that we determine if this is true. We use the high-low method to accomplish this. The month with the lowest utility cost is May. So we look for the lowest cost. Then we look for the highest cost, and that was June. Production volume in May is 6,000 units, and that's the lowest. In June, it was 18,000 units, which is the highest. You can see by applying the high-low method, where we take high cost minus low cost, and then we divide that by high activity minus low activity to determine that variable costs on a per unit basis were 25 cents per unit. With the variable rate known, the fixed cost element can then be calculated at either the high set or the low set of data. And the cost formula can then be developed because total cost is equal to variable costs plus fixed costs. At 18,000 units of activity, the total variable cost is 18,000 times 25 cents per unit, or $4,500. Based on the variable and the fixed cost behavior patterns, we can see that utilities is a semi-variable cost. Subtracting the total variable cost of $4,500 from the cost in that month of $5,000 gives us a fixed cost element of $500.